ACCA 16. Leases, effective January 2019, is a significant accounting standard issued by the International Accounting Standards Board, or IASB. This standard represents a major shift in how leases are accounted for and reported in financial statements. It provides a comprehensive framework for the recognition, measurement, presentation, and disclosure of leases. This framework is designed to ensure that all relevant lease information is captured accurately and consistently across different companies and industries. This standard aims to increase transparency and comparability in financial reporting by requiring companies to recognize most leases on their balance sheets. By doing so, it helps stakeholders better understand a company's financial commitments and the resources it controls. Before IFRS 16, companies could classify leases as either finance leases, which are on balance sheet, or operating leases, which are off balance sheet. This dual classification system often led to confusion and a lack of clarity in financial statements. This classification often led to inconsistencies and made it difficult to compare companies' financial positions. Different companies might report similar leases in entirely different ways, making it hard for investors and analysts to get a clear picture. IFRS 16 eliminates this dual model, bringing most leases onto the balance sheet. This change simplifies the accounting process and enhances the reliability of financial information. The standard impacts lessees more significantly than lessors. Lessees now have to account for leases in a way that reflects the economic reality of their lease commitments. Lessees must now recognize a right-of-use asset and a lease liability for most leases. This means that both the asset and the liability are recorded on the balance sheet, providing a more complete picture of the company's financial position. This change provides a more accurate representation of a company's assets and liabilities. It ensures that all lease-related obligations are visible to stakeholders, enhancing the overall transparency of financial reports. Understanding IFRS 16 is crucial for businesses engaged in leasing activities. Companies need to be aware of how this standard affects their financial statements and what steps they need to take to comply with it. This guide provides a comprehensive overview of the standard, its key provisions, and its impact on financial reporting. By understanding these elements, businesses can better navigate the complexities of lease accounting and ensure they are meeting all regulatory requirements. IFRS 16 aims to enhance the transparency and comparability of financial statements by providing a more faithful representation of leasing transactions. This is crucial for stakeholders who rely on accurate financial information to make informed decisions. By ensuring that leases are properly accounted for, IFRS 16 helps in presenting a true and fair view of a company's financial position. The standard achieves this through several key objectives, each designed to address specific issues in lease accounting. Eliminate off-balance sheet financing. IFRS 16 aims to eliminate the distinction between finance and operating leases for lessees. This means that companies can no longer hide significant liabilities off their balance sheets, leading to greater transparency. This change ensures that all leases, with limited exceptions, are recognized on the balance sheet, providing a more accurate depiction of a company's financial obligations. Improve the quality of financial information. By bringing leases onto the balance sheet, IFRS 16 provides users of financial statements with a more complete picture of a company's assets and liabilities. This comprehensive view is essential for investors, creditors, and other stakeholders. Enhance comparability. The standard promotes consistency in accounting for leases across different industries and jurisdictions. This uniformity allows for easier comparison of financial statements, making it simpler to evaluate the financial health of different companies. Reduce complexity and cost. IFRS 16 aims to simplify lease accounting by eliminating the need for complex classification tests. This simplification reduces the administrative burden on companies and lowers the cost of compliance. These objectives contribute to a more robust and reliable financial reporting framework, enabling stakeholders to make better informed decisions. By achieving these goals, IFRS 16 plays a vital role in enhancing the overall quality and reliability of financial reporting in the global economy. IFRS 16 applies to all leases, including subleases with limited exceptions. The standard defines a lease as a contract that conveys the right to control the use of an identified asset for a period of time in exchange for consideration. Covered leases, equipment leases, for example, vehicles and machinery. Real estate leases, such as offices and warehouses. Leases of intangible assets like patents and copyrights. Exceptions, short-term leases, which have a lease term of 12 months or less. Low-value leases, for example, personal computers and small office furniture. Leases of biological assets, such as timber and livestock. Understanding the scope of IFRS 16 is essential for determining whether the standard applies to a particular lease arrangement. Example 1. Equipment lease. A company leases a printing machine for 5 years. This machine is essential for the company's daily operations, allowing them to produce high-quality prints efficiently. The lease agreement specifies that the company has the right to use the machine, determine its operating hours, and benefit from its economic output. This means they can schedule its use according to their needs and maximize productivity. This arrangement meets the definition of a lease under IFRS 16, as it conveys the right to control the use of the identified asset for a period of time in exchange for consideration. Example 2. Real estate lease. A retail company leases a storefront for 10 years. This long-term lease allows the company to establish a stable presence in a prime location, attracting a steady flow of customers. The lease agreement grants the company exclusive rights to use the space for its retail operations. This exclusivity ensures that no other business can operate in the same space, giving the company a competitive edge. This arrangement also falls under the scope of IFRS 16, as it provides the company with the right to control the use of the leased property. Example 3. Lease of intangible asset. A software company leases a patent for a new technology for 7 years. This patent is crucial for the development of innovative software solutions that can give the company a technological advantage. The lease grants the company the right to use the patent in developing and selling its products. This enables the company to create unique offerings that can differentiate them in the market. This arrangement is considered a lease under IFRS 16, as it involves the right to use an identified intangible asset for a specified period. These examples illustrate the broad range of lease arrangements covered by IFRS 16, highlighting how it applies to both tangible and intangible assets across various industries. Section 5. Key changes from previous standards. IFRS 16 introduces significant changes to lease accounting. The most notable change is the elimination of the distinction between finance and operating leases for lessees. Key changes include the recognition of right-of-use assets and lease liabilities. Lessees must recognize a right-of-use asset and a lease liability for most leases on the balance sheet. The standard replaces the dual model with a single model for lease accounting, simplifying the process. Moreover, IFRS 16 requires more extensive disclosures about leasing activities, providing greater transparency. These changes have a profound impact on the financial statements of companies engaged in leasing activities. Section 6. Impact of IFRS 16 on financial statements. The adoption of IFRS 16 has a significant impact on a company's financial statements. On the balance sheet, there is an increase in assets due to the recognition of right-of-use assets. Similarly, there is an increase in liabilities because of the recognition of lease liabilities. This change also affects key financial ratios such as debt to equity and return on assets. On the income statement, there is a different expense recognition pattern. Instead of recognizing rent expense on a straight-line basis, IFRS 16 requires the recognition of depreciation expense on the right-of-use asset and interest expense on the lease liability. On the cash flow statement, lease payments are classified as financing activities rather than operating activities. Companies need to carefully analyze the impact of IFRS 16 on their financial statements and make necessary adjustments. Section 7. Benefits of implementing IFRS 16. Implementing IFRS 16 offers several benefits for companies. Improved transparency is one of the key benefits, as the standard enhances transparency by providing a more accurate picture of a company's leasing activities. Enhanced comparability is another advantage, as IFRS 16 promotes comparability by standardizing lease accounting practices across different companies and industries. Better decision-making is facilitated by the increased transparency and comparability, which benefit investors, creditors, and other stakeholders. Additionally, recognizing lease liabilities on the balance sheet can improve debt management by providing a more complete view of a company's financial obligations. These benefits contribute to a more robust and reliable financial reporting framework. Section 8. Challenges of implementing IFRS 16. While IFRS 16 offers numerous benefits, its implementation also presents some challenges. Data gathering and system changes are among the first hurdles. Companies need to gather lease data from various sources and potentially upgrade their accounting systems to comply with the standard. Training and education are also crucial, as staff training is essential to ensure a smooth transition to the new lease accounting requirements. The impact on internal processes cannot be overlooked. IFRS 16 may necessitate changes to internal processes such as budgeting, forecasting, and performance measurement. Lastly, ongoing compliance is key. Companies need to stay abreast of any updates or amendments to the standard to maintain compliance. Addressing these challenges effectively is essential for a successful IFRS 16 implementation.